As the U.S. Federal Reserve hiked interest rates on March 10 and scared away prospective investors from Silicon Valley Bank.
The Reserve has raised interest rates by a quarter.
The Reserve expected to decide whether to raise interest rates.
The Federal Reserve, this crossing just a few seconds ago, has raised interest rates by...
Comments from Treasury Secretary Janet Yellen, who signaled this morning...
which was best known for its partnerships with high-flying global technology firms and venture capital. A bank run struck a fatal blow, forcing its downfall. Its collapse is the worst financial institution failure in the United States since Washington Mutual in 2008. To know about the Silicon Valley Bank collapse, kindly watch this video till the end. By the end of this video, you will know what made this giant system bankrupt. Stay with us. SVB was once ranked as the 16th biggest bank in the United States overall, and it was one of the major banks catering to the technology startup business. A typical bank run occurred when the bank was forced to sell bonds at a loss. This caused the stock price of the bank to collapse, which in turn caused depositors to panic. This was the second biggest bank that has failed in the history of the United States. According to its website, Silicon Valley Bank served more than 2,500 venture capital firms and over half of the nation's venture capital-backed technology and life science enterprises. Silicon Valley Bank, loaded with cash from successful startups, followed the standard practice of its competitors for decades by investing most of its deposits in long-term debt, such as government bonds. By then, interest rates were low. The investments would provide a consistent small profit. Unfortunately, they proved to be short-sighted. The bank hadn't accounted for the fact that the economy as a whole was overheated due to global stimulus policies that had been in place for over a year. As a result, Silicon Valley Bank was shocked when the Federal Reserve began hiking interest rates to battle rising inflation. When the interest rates on newer government bonds increased, the old ones suddenly looked dangerous. Yet not all of Silicon Valley Bank's troubles are due to increased interest rates. The bank was exceptional in aspects that led to its abrupt downfall. Since the bank's business was centered in the IT sector, Silicon Valley Bank started to notice difficulty as startup financing began to decline, forcing its customers, a combination of technological startups and their leaders, to tap their accounts more. The bank also had a considerable number of huge, uninsured depositors, the sort of investors that tend to remove their money amid signals of trouble. To meet its customers' requirements, the bank had to sell some of its assets at a significant discount. As a result, the tech sector panicked as Silicon Valley disclosed its enormous loss, and startups rushed to withdraw their money, leading to a bank run. Seeing all this happening now, a question arises: will it affect other banks? The failure of Silicon Valley Bank has shed light on the difficulties that are faced by small and mid-sized banks. These banks have a propensity to concentrate on specific types of businesses and can be more susceptible to customer runs on the bank than their larger competitors. The most pressing worry is that the bankruptcy of one bank may discourage people from banking with other financial institutions. The $209 billion in assets held by Silicon Valley Bank and the $110 billion held by Signature pale in comparison to the more than $3 trillion held by JP Chase. Silicon Valley Bank and Signature are both modest financial institutions in comparison to the top banks in the country. Yet bank runs may occur if consumers or investors get terrified and begin withdrawing their money in large numbers. There is no guaranteed explanation for why the $212 billion tech lender unexpectedly failed, causing the worst financial crisis since 2008. Was it the consequence of regulatory rollbacks under the Trump administration, poor risk management by the bank, sudden interest rate increases after a decade of very cheap borrowing costs, or even a mix of all three, as some claim? There are ongoing federal investigations, pending litigation, and undoubtedly upcoming financial problems. These are the main reasons why analysts think SVB failed. However, for the time being, Trump rollbacks. Senator Sanders of Vermont blames Congress and Trump's signature on an absurd 2018 law that rolled back some of the credit requirements imposed by the Dodd-Frank banking legislation passed in the wake of the 2008 financial crisis. Banks with more than $50 billion in assets are subject to an annual stress test by the Federal Reserve and must have a minimum amount of capital on hand and a contingency plan in place in case of insolvency under Dodd-Frank's regulation. SVB CEO Greg Becker testified before Congress in 2015, arguing that the $50 billion barrier was unnecessary because SVB, like other mid-sized or regional banks, did not offer systemic threats. At the time, SVB controlled $40 billion. Trump said that the new legislation goes a long way towards correcting the job-killing Dodd-Frank law. Before the law was enacted, however, the nonpartisan Congressional Budget Office expressed concern that doing so would raise the risk that a big financial corporation with assets between $100 billion and $250 billion will collapse. Joe Biden has expressed a desire for a reversal of Trump's rollbacks. SVB's management, the Federal Reserve, is reportedly looking into why the bank operated without a chief risk officer, CRO, for a portion of 2022. Former SVB CRO Laura Igerietta departed the business in October, although she ceased acting in that capacity in April. In December, someone else was put in charge. But many meetings of the board's risk committee before the bank's collapse have been linked to speculation that early shareholder lawsuits against SVB may focus on the important vacancy. Reed Cathrine, a lawyer who specializes in shareholder litigation, told Bloomberg that this may indicate either management was concealing something or didn't want to disclose anything or had conflicts about the risks it was taking. According to investor Danny Moses, who foresaw the 2008 financial catastrophe in the book and film The Big Short, this isn't greed, necessarily, at the bank level. Poor risk assessment is to blame. SVB's approach to risk management proved disastrous, but social justice advocates have been blamed for the failure of SVB in Signature, the second mid-sized bank in a week. One of the most awake institutions, according to Republican House Oversight Committee Chairman James Comer. Environmental, social, and corporate governance, ESG, investment has been a target of conservatives, and this story contributed to that struggle. The bank's diversity, equality, and inclusion, DEI, principles are not out of the ordinary, and neither are the loans it made to community and environmental initiatives. The argument also disregards the fact that there were many banks in existence in 2008, before terms like DEI or woke entered the lexicon of business and politics. Although SVB was so obsessed with DEI and politics and all sorts of things, as Florida Governor Ron DeSantis put it in an interview with Fox News, the theme was perpetuated. I believe that sidetracked them from their primary goal, inflation and interest rates. Since last year, the Federal Reserve has gradually increased interest rates from their historically low levels in an effort to curb inflation. As available funds become more costly owing to rising rates, investors become less willing to take risks. Because of this, Silicon Valley Bank's major clientele, technology startups, has more difficulty attracting funding as investors become increasingly cautious. More than a decade of zero-money interest rates benefited SVB as billions were deposited by tech venture capitalists. It invested the funds in long-term U.S. government bonds in the hopes of earning a return. But the bank was compelled to sell some of those bonds at a loss when interest rates began climbing dramatically last year and depositors wanted better yields. Social media spread the news, and it caused a classic bank run among its investors. It then took another 36 hours for the second largest bank collapse in American history to occur. Before the crashes, investors were counting on a quarter-point or half-point increase in interest rates from the Federal Reserve meeting of the Fed's governors. So central bankers are stuck between a rock and a hard place. Either continue hiking rates to manage inflation, which is still running at 6%, or continue restricting money supply, which might cause another breakdown in the financial system. Treasury Secretary Janet Yellen hinted at the need for additional effort on inflation in her testimony before the Senate Finance Committee. Seeing all this happening now, a question arises. Will it affect other banks? Here is the answer. Meanwhile, it's becoming increasingly apparent that investigators will find additional issues at the banks as they dig deeper. Investors and savers may become even more anxious in light of these discoveries. I hope the video was entertaining. Your thoughts in the comment section are much appreciated. Have a nice day, and I'll see you in the next one.